Okay, so this is July month, so we can uh, merge these cells, saying that July. Then we do the same thing for August in the same uh, the next site. Right after this, you have to less cost of sales. Right. So what are the things coming under the cost of sale? You have opening inventory. Then you have production. You have to add the production. Then you have to less the closing stock. Right. So this is how you calculate the cost of sales. Then after this, after calculating this, what you have to do, you have to get this part, which is less variable non-production cost, non-production overhead, variable non-production overhead. Then after you less that, you will arrive at the contribution. Contribution, you can learn it in another video. So I have posted that, or I will be posting it. How to calculate the contribution and what is about contribution. Right. Then after that, what you can do, you can less fixed cost. Fixed production cost and fixed non-production cost. Right, so you less both of them. Then finally you will arrive at the net profit. So let me make a color for July. I'll make a bright color so it will be easier to look at it. Then I'll make a color for August as well. So this is August. Okay, now let me go and create the absorption costing statement as well. So under the absorption costing, what is the format of the statement of profit or loss? So again, we get sales, we get less cost of sale, then again opening inventory, and add the production. Normally in other profit or financial profit or loss, you should be adding the purchases here. So but in management accounting, under the absorption costing and marginal costing, you don't add or you don't mention any purchase. We don't purchase here, we produce here. Right, so that's why we are mentioning the production here. And finally you have to less the closing stock. Right, after that what you have to do, you have to adjust it for under or over absorption. Right, so that is what we already mentioned here as well. What you have to do, you have to adjust it for under or over absorption here. Right, so After adjusting for that, you arrive at the gross profit. Then we have to less all the non-production variable, non-production, or otherwise we can say variable non-production overhead cost, and you have to less the fixed non-production overhead. Why? Because here in this comparison I'm saying that periodic cost under absorption costing, selling and distribution cost, all the non-production cost, right? But under marginal costing, that is fixed production cost and fixed non-production cost. So that means these are the things, non-production cost. So here actually all non-production cost are periodic cost under absorption costing. So under absorption costing, all non-production cost. So this is a variable non-production cost, and this is fixed non-production cost. So these all are considered as periodic cost. But when it comes to marginal costing, all fixed cost, very carefully you have to understand this, all fixed cost, that is non-production and production cost. So you can see here fixed production cost and fixed non-production cost. These both are considered as periodic cost under the marginal costing. That is, this is the rule that we have to follow. Right. After considering everything, so let us calculate the profit. The same thing here. Right. So they are saying, first of all, you need to calculate the sales under marginal costing. How much is the sale? You know, they are saying the sales units for the month of July, that is 12,800 units. You can see here 12,800 units. So the price for each unit is 60 pounds. So you can say 12,800 units in July into 60 pounds. So you get 768,000 pounds as a sales figure. Then when it comes to cost of sale, opening inventory. What is the opening inventory during July? That is 0. Why it is 0? Because they say there were no stock at the end of June. That means there is no any closing stock during June or in the month of June, so that there is no any stock that are carried forward for the month of July as an opening balance or opening inventory. So that's why we have put 0 here. Then production, when it comes to production, you can see here for the month of July, the production is 14,000 units. Okay, 14,000 units into what? This is inventory valuation. Okay, so that is what you have to go here, and I have mentioned here, you can see inventory valuation under the marginal costing. You want to add the direct material, direct labor plus direct expense plus variable production overhead. So let me add that here. Let us add here and see for this question. So what is the direct material here? So let me write it here, let it be easy for you. Direct material plus direct labor plus direct expense plus variable production overhead. Right? So let's go to the question and see. Direct material cost is 20 pounds shown there. Direct labor cost, that is direct wages, that is 6 pounds, and variable production overhead, so there is no direct expenses, so variable production overheads, yeah, that is 4 pounds. So your answer will be 30 pounds. So here 14,000 is the July production units into 30 pounds. Then after that you have to less the, right, so after that you have to less the closing inventory. So how much is the closing inventory? So in order to calculate your closing inventory, what you have to do is you have to get the production units and you have to minus the sales unit, right? So during the month of July, the production units are 14,000. Out there is no opening stock. If there is opening stock, you have to add the opening stock. So let me start with the opening stock. Opening stock is 0 plus production. So you have produced 14,000 units. Out of that you have sold 12,800 units. So you minus the sold ones. So you get 1,200 units that are remaining at the end of July. So into the same 30 pounds. Okay. So you get this, you get 36,000. So you add, so you get the 420,000 minus, because there is less closing inventory. So minus 36,000, you are getting 384,000. Okay. What's next? The next thing is you have to get the difference of this, because sales minus cost of sale. So cost of sale is 384,000. So you have to get this figure minus this figure. You are getting 384,000. Then after that you have to deduct the variable non-production cost. What is the variable non-production cost? That is here. This variable selling and expenses, 50% of the sales value, 15% of the sales value. So selling and expenses, non-production overheads, and it is variable. So all the variable cost, whether it's production, non-production, you have to take it for the contribution calculation. This is very important point. So you get 15% of the sales value. Sales value is 768,000 into 15%. Okay. Then you have to less this. Yes, less variable. So that 384,000 minus 150,000. Your contribution is 268,800. After that, what you have to do? You have to less the fixed production cost. What is the fixed production cost? That is this one, fixed production overhead, which is 99,000. So 99,000 less, and less the fixed non-production overhead. So non-production means selling and expenses are non-production, administration expenses are non-production. That is what I have given here. See, administration overhead, selling and distribution, these all are non-production. So let's go and add the value. So fixed selling expenses and fixed administration expenses, that selling expenses 26,000 plus you have to add the administration expense. So sorry, administration is 26,000, selling is 14,000. So you get 40,000 for the non-production and production fixed cost. Then after that, what you have to do, you have to calculate the net profit. That means contribution. You have to start from contribution minus the fixed production cost and minus the fixed non-production cost. Your net profit will be 120,000 29.